Hello everyone, thanks for joining us today for our Impact Innovation Lab webinar. My name is Isaac Tucker and today's topic is focused on testing assumptions for financial forecasting. And that will be presented by Kelly Dyer. So while we're waiting for some others to join, I'd just like to say a quick thanks to some of the organizations that made this webinar possible. So firstly, thank you to IWG. International Workspace Group have over 90 co-working locations across Australia and more than 3,000 across the world, making them one of the world's largest co-working networks. For everyone's information, Impact Innovation Lab members can actually obtain discounts from IWG, and this is included in the webinar download information. Secondly, thank you to Bright Idea. Bright Idea is a US-based organization that has fantastic innovation management platform software, and it's used by companies such as Wesfarmers, AIG, Cisco, Kraft, GE, and Bayer. They have a number of really good playbooks on innovation process and process diagrams that are really worth sharing. So we've included the challenge round documents in today's download pack as well. And lastly, thanks to the team at Impact Innovation, who've been supporting innovation and commercialization activities for the last 13 years and have developed a number of related tools in which the details are also attached. All right, so just before I introduce Kelly and kickstart the presentation, I'll let everyone know that we're doing a Q&A session at the end. So if you have any questions throughout the presentation, please type them in and we'll get to them at the end of the presentation to keep it running smoothly. So I'd like to hand over to Kelly. Kelly has applied her highly regarded skills in business, technology, and innovation to support large infrastructure organizations, small and medium-sized businesses, academia, and other research centers. Working as the adoption and commercialization manager for a research-based organization allowed Kelly to appreciate various different commercialization strategies. Kelly is the non-executive director of a financial services organization and a national research organization as well. She's been involved in a number of strategic projects, including launching spin-offs and rebranding and repositionings to other types of organizations. So I'll now pass it over to Kelly.
Great. Hi everyone, and thanks Isaac for the great welcome and introduction. And I hope everyone's doing fine on the line and that everyone can hear me. If you've got any problems at all today, you can type in and let us know if the audio is not working or you're having any issues with the screen, and also feel free to type in any questions that you might have. So welcome, and I'm delighted you could join me. We've only got half an hour, which is not a lot of time to talk all things financial. So I've really tried to keep this high level without getting into any particular detail of one particular aspect, but realistically with financial forecasting and financial assumptions, things can really get quite detailed. So our topics for today are going to include, what are financial assumptions? What is financial forecasting? How do you test assumptions and forecasts, and why do you need to test assumptions and forecasts? And how do assumptions, forecasts, and innovation all fit in together? Because that's quite a little bit of a spin on it. And then at the end, if we've got any time left, we'll answer some questions for you. So don't be shy in sending those through. So what are financial assumptions? I can't stress enough that financial assumptions are only assumptions. Some people will call them a best guess. Some people call them a best estimate. But assumption is actually an element, an item, a financial number, a definition that you assume to be true or accurate. You take it in the best of spirits and you assume this without the need for any proof. So you don't have any evidence about an assumption. You couldn't say where you found the figure from. It's something that might have, come out of your head. It could be something that's come out of your gut, and it's just a gut feeling that you've had. And so financials are the financial details of any entity, and the financials could include expenditure, inventory, revenue, shares, stock. And so when we talk about financial assumptions, we're talking about the assumptions of those many different elements that relate to your business. Financial assumptions are generally details that are gathered to provide information that sort of lets you predict the future financial state of an entity or your business. Assumptions are required when there's no historical data. Assumptions can build on historical data, and assumptions are very useful when you're planning and devising and looking to set and start a business. Some organisations are required to produce and publish annual reports, large organisations with shareholders, not-for-profits, etc. And those annual reports include financial information. Quite often, in the notes to accompany these reports, you will find information around the assumptions that have been used to gather the data together. Sometimes these notes to accompany those financial statements can be more detailed and more consuming than the actual financial statements themselves. So if you're looking to start a business, financial assumptions will be important for you in the planning and measurement and performance of your business, but also too, if you're someone who's invested in a business, you'll be able to look at the financial assumptions of the businesses that you've invested in by looking through their annual reporting publications that they produce. With your financial assumptions, you may also be able to base those assumptions on actual data. So you may have data for a year or two, and you might be able to predict and extrapolate out some sort of future financial position based on that historical data that you have. You would be able to, have to be able to justify those underlying assumptions, and you'd have to be able to justify that you've based that on your historical data. And that's something a lot of people can do if they have been trading. But if you're pre-revenue, you'll be making your assumptions about a future state that you hope and plan to achieve. So what is financial forecasting, and how is the forecast different to assumptions? Assumptions are the reasoning, the rationale on which you base your forecasts. And the forecast then leads to the estimate or the prediction of how the business will perform at a point in the future or a number of points in the future, depending on why and how you are doing your forecasting. Forecasting applies to all aspects of your business. So you can forecast on revenue, you can forecast on your expenses, you can forecast on profit, you can forecast the number of employees you might need, the amount of office space, warehouse space, other assets that you might need. You can forecast all that based on your predictions and assumptions made around your sales. I said in the previous slide that assumptions are not really based on fact, or they're based without any real evidence. And they're a little bit more open-ended. Financial forecasting also relies on those assumptions, but there's usually one of 4 methods that people will use to do their forecasts. And you can do a straight line method of forecasting, which is based on sales growth rate and historical data. You can use moving average format, which will be a bit of a smoothing technique, and that looks at patterns of data and averages information over time, over periods of time, and allows you to forecast based on historical data once again. If you were doing some sort of linear regression, you can do some simple linear regression, so that links the relationship between variables. So an example of that might be the amount of money you might have to spend on advertising should generate a corresponding level of revenue. If the advertising budget is increased, then you would expect your revenue to increase at a similar rate. So that's just using 2 variables to compare, and there's that cause and effect. The other way you can forecast, or the last way you can forecast, is doing multiple linear regressions or multiple analysis. And if we build onto the previous example that I gave about your advertising cost should generate a certain amount of revenue, but if you was to say take your advertising cost and marketing cost and look at the spend on those variables and the resulting revenue that they would generate if you had the 2 assumptions together. So in those instances, those assumptions are considered to be the estimates and the best estimates that you can make and that are considered to be reasonably accurate, true and certain to happen. Wild and ambitious assumptions will be spotted quickly by investors, by the general public, by auditors, by accountants, by anything. So if you're going to do any of those forecasting methods, make sure that you keep your information and your assumptions reasonable and are able to defend your thinking or your experience or why it is that you got to those figures there. What could a financial forecast look like? And a lot of people, when they're starting a business, always say to me, well, what should I include in a financial forecast? What does it need to have? The reality is there's some certain accounting principles and standards that you should adhere to, but if you're just starting to do a forecast, you've got to include things such as your assets, your liabilities, your shareholding, equity, if you've got any revenues, cash flow statements. And your forecast will really depend on who it is you're preparing the forecast for and what the information is that they're going to need. So if we look at the example on the screen, it's a forecast that's been able to build on it's included historical results, and it's used those to make assumptions and to predict out to the future. And you can see at the top there in line 8, there's a line that says assumptions. The rationale or the assumptions that are used would potentially be included at that point so that the reader who's trying to interpret the data will be able to understand what those assumptions are. In one of the businesses that I'm associated with, we will do the historical results like this in a different way. We'll actually have 2 lines of data in the historical results. We will have a line that says forecast, and we'll have a line that says actual. And that allows us to compare, obviously, our forecasted figures with our actual figures. And it also tells us another story, or it can also provide us with additional information. It can tell us if our forecasting has been accurate, how close to the market our assumptions were. And that's important. If our forecasting is consistently wrong, consistently off the mark, what are we learning from that exercise where we can then change our assumptions perhaps, change the method that we're using to forecast, so we can try and refine our assumptions and our forecasting to get them closer to our actuals. Sometimes it's really difficult to predict your assumptions, or it's really difficult to make your assumptions confidently because you might be the subject of external forces that you have no control over. But you really do have to factor in, there'll be information from the market that will tell you what's going on. So you should be able to at least reasonably predict what might come out of those. Also too, by doing the charts in the years, or doing this spreadsheet in the years, you can actually look for any glaring issues that might be arising. So in this example, if you were seeing that long-term debt was increasing rather than decreasing, you'd want to understand what was going on there. If you could see shareholders' equity decreasing incredibly quickly, you'd want to find out what's happening in the organisation that way. If accounts receivable were blowing out, if your inventory was getting too high, there's a whole lot of information that you can tell from preparing these charts and graphs and spreadsheets. And I really do think there's value if you are fortunate enough to have some historical data to actually compare your historical forecast with your actual forecast, and not to use those to berate anybody for getting it wrong, but try and understand what it is you might need to do to get things closer to being more accurate in the future. So why do you need to test? Revenue, liquidity, profit, why does it all add up? What's going on there? And investors, if you're preparing, as said earlier, it'll depend who you're preparing these documents for as to what sort of assumptions and what sort of information you will include with them. But investors and financiers will always test your data to ensure they just understand the financial risks around any potential investment. They understand what they're getting in for, and they will test the assumptions that you've made to just see how real world they are. Your potential investor or financier might not have as much knowledge about the market as you have, but they will have an idea in their mind of what it is they think is reasonable assumptions and reasonable basis to get the forecast that you've got. You also need to test to ensure that the information you've got is accurate and reliable. So if we refer back to the previous spreadsheet, there'd be a lot of formulas and a lot of calculations and a lot of other automatic activity happening in the background. If one formula is wrong, that will magnify itself over a period of time, and that order of magnitude will intensify the longer that mistake is carried through. So if you test and ensure that your formulas, your data entry, any sort of automatic calculations and updates you have in the background, if you test those to ensure they're accurate and reliable, because if investors and financiers have a really high exposure to financial data, they will spot an error very, very quickly. So I always encourage business owners to really, get out a calculator and double check a certain number of columns and certain number of cells and make sure the figures just add up. You need to be confident too that, so you test to ensure accuracy, completeness, and that everything that you've done in the background is the right way. Because as a business owner, you need to be confident that your forecasting is as accurate as it can be. And the reason for that is you may be forecasting that you've got some future liquidity issues that might be a problem for you. You may have some issues with asset and enough space to store inventory or stock if you're still working in that method. You might have depreciation on assets happening, which means you need to replace them. You've got liquidity issues coming up. And they're not things that you should be scared of. They're things you should be developing a plan to manage through. And again, if you're looking at speaking with potential investors or financiers, they don't like surprises. So telling them bad news and doing a forecast that might say you've got some liquidity issues arising is never a bad thing. Also, too, the liquidity issue might be the reason why you're speaking to a financier or an investor, and they'll take comfort in the fact that you're telling the complete story as you know it to be. The other reason about testing is, conversely, you might be facing the opposite problem, and you might be looking at liquidity excess, and you might be thinking, wow, why is that a problem? The problem with that is how to best use any excess that you might be generating. So liquidity deficits or liquidity issues will be, when your cash and your bills aren't going to be covering, or your cash isn't going to be covering your bills. What if you're getting more cash than you need? So you're creating this excess of revenue and this liquidity in your business. What are you going to do with it? So being able to forecast the converse and what seems to be the beautiful problem of having too much money is then you can just start to look at where you might need to make big cash investments back into your business. You might need to reinvest your profits. What's going to be the time when you're going to need that most? Rather than, maybe paying your money out as returns to shareholders, you might be able to convince your shareholders that it's better for you to invest that money, because in a year or two, you're going to have to replace some big assets, and you'll be able to use that money either to pay for those assets or put down a deposit on them, or whatever the nature is that you're going to do that, depending on your particular tax situation. So we'll move on from testing and why you need to test, and we'll talk about the most common form of actually testing your financials assumptions and your financial forecast. And the most common way to do that testing is to stress test and to gather your evidence. So with stress testing, you use scenarios to test if your assumptions and forecasts will be able to deal with a crisis. So most people will base their assumptions and forecasts on the here and now, what they know to be true today, they'll use assumptions that the whole business environment that they're working in stays as usual. So it's a status quo type situation. So considerations in stress testing may include external forces that are going to impact on your business and how that will affect your assumptions and your evidence and your forecasts and what that's going to do to it. You might be someone working in the agriculture space and you're highly dependent on natural resources, and you get your natural resources from a space that has just experienced an extreme event and wiped out all the stock that you need to access. So if your total supply was annihilated, what would that do to your balance sheet? What would that do to your forecasts and your financials? So how do you get that into your spreadsheets and have a look at it? So that stress testing looks at those extreme events, the ones that are unlikely to happen, but they may just happen. It might look at unprecedented changes in interest rates, which are very topical at the moment. So we've got an incredibly low interest rate environment. What if something external happened in that environment and we all wake up tomorrow morning and all of a sudden interest rates have gone back up to 35% or something? Again, it's probably unlikely to happen, but is it something that you should look to stress test and see how your balance sheet would react to that? Whilst that would be an extreme change in your business, based on your forecasts and assumptions, would you be able to manage through it? Based on your forecasts and assumptions, how would those changes affect your revenue? How would they affect your sales? What is it that you could do to change it? You also need to stress test before, as I said, because financiers and investors will put your financials under a microscope and look for them. And look for any errors or omissions or anything that they can question you about that they don't like. And the investors and financiers will ask you about how you've tested your assumptions and how you've tested your forecasts. And they will use that again as another way of understanding how realistic your assumptions and forecasts are. They'll also use it potentially as a way of trying to understand and analyse and assess the risks involved in your venture or your business. So if you say you have stress tested and these are the scenarios you've used, you know, in an incredibly high interest rate environment as opposed to a very low interest rate environment, or loss of your sole only supplier, they'll understand and start to learn what you know are the risks of your business. They'll work with you to try and understand, or they'll speak with you to try and understand how you've managed through or analysed or searched out ways to counter those risks. It might be that you decide that your business, if you're only just planning and starting out, you might decide that you need to do a whole different business model or go-to-market strategy. If you've got an existing business, you might need to think about who you could partner with, who you could collaborate with to get you through those ups and downs. Investors and financiers will also use a whole lot of other economic and external data to assess your assumption and forecast. And they'll also, they might apply their own scenarios to your figures. So what I also suggest to people when they're doing their assumptions and doing their financial forecasting, and we saw it in that previous spreadsheet, is keeping records of the documents you've accessed, or the URLs of websites you might have visited where you've gathered your data to base your assumptions and forecasts on. So if you were looking at a report, say from the chief economist on interest rates, you would reference where you got that from if you were looking to make your assumptions and changes that way. And investors and financiers will want to know what sources you have used, because they'll want to understand what sort of evidence, what sort of data you've used. They want to understand that it's been credible sources. And again, why do you need to test? You need to test because potential investors and financiers will challenge and test everything. And you need to know that your assumptions and forecasts are robust. You'll need to know that they can stand up to scrutiny. And you need to ensure that you've got, as a business owner, accurate and reliable information on which you're basing and making your decisions. You need to be confident that any forecast liquidity issues are well founded and that you can plan to manage through them, that you can manage through any sort of people issues, as in needing to have more and not being able to afford it. So how are you going to work around it? So that's, you know, why you really need to do it. But particularly potential investors and financiers will be ruthless with testing and challenging your assumptions and forecasts. So be as ruthless as you can with those figures before you take them out. Get other people to interrogate them, to check spreadsheets, cell entries, to check formulas, make sure that the right, you know, cells are being added up. In one business that I'm involved with, we are audited every year, and they randomly pick some of the spreadsheets that we use, and that's exactly what they do. They go in and check and test that our formulas are correct, that we're referencing the correct cells, that we're doing all the sort of things that we need to do. So I'd encourage you to do that as well. Much smaller scale, of course, but that's what you know, can do to ensure that your figures and your spreadsheets are as robust as possible. So lastly, I'm going to finish up with, you know, financial assumptions, forecasting and innovation. Obviously, you know, the focus of our business and what we do is working in that innovation space, and we work with organisations from pre-revenue through to global expansion and scale up. And everyone, regardless of where they are in that business life cycle, they always need financial assumptions and forecasts. So how is this particularly, or why is this particularly important if you're a startup and you're in the innovative space and you may even be, you know, just toying with some ideas in your head at the moment? Typically, a lot of the people we see in the innovative space, if they're a small business or a sole operator, they're actually looking to establish a business, and they won't have any trading history. They might have a little bit, but they won't have any typically. Or if you're looking to establish your business into a new market, you might be dealing with people who do not know you, people who don't know anything about your history, your business achievements, and what it is that you've done. Having a plan, a financial plan, and having assumptions and forecasts ready to go is a great idea. If you're working in an innovative area, you're bringing in a disruptive technology, or you're just bringing in a disruptive business model based on old technology, it doesn't always have to be something shiny and new. Having some sort of financial forecast and using that based on good assumptions will give people a little bit more confidence in something that they already see as a risky venture. With anything new, people can be resistant to change and they can be very skeptical. But if you can go in and be really confident with your financial forecast and know that your assumptions are right on the money, then that's going to, you know, give you a lot more credibility in that area, and people are going to believe and be confident in you that you can actually do it. With any pitch for investment and finances, if you're in the innovation space, typically you are looking for some sort of investment and financing. Your financials are going to be scrutinised, but if you're doing something new and you're working with, you know, new risky areas, new risky businesses, your scrutiny is going to be even stronger. You know, if you think you have a potential total market size for the sale of, you know, 10,000 units and you're bringing a new product to market, don't assume or estimate that you will sell 10,000 units in the first year. No financier or investor's going to actually believe that. Be prudent, be real, and go, you know, better to under promise and over deliver, isn't that what they say? So, you know, say, well, you're aiming for 4,000 units in the first year. If you get 5,000, 6,000, 10,000, they're going to be extremely happy. It's better to underestimate and forecast your successes rather than overestimate. And if you can secure your funding based on lower estimates, your return is going to be better because you're, you know, depending on how you're financing and how you're investing, you may be giving away equity in your business. So the less you can do of that, potentially the better you will be. Also too, if you're pitching to potential investors, try and learn about them and what it is they are particularly focused on. Some investors will be very focused on return on investment. Some investors will be really looking for longevity of the business. They might be happy to accept a smaller return, but for over a longer period of time. Some investors are going to want to know what your exit strategy is. How quick are they going to get their money back by you making a sale? How quickly is that how their investment's going to be repaid? Some investors will be interested in understanding, what it is, how it is you're going to grow and expand. If your financial forecasts are looking realistic and quite positive, they'll be wondering, what it is they can actually contribute. So the financial assumptions forecasting and in that innovation, because it's such a risky space and it is seen as a risky space, your financial assumptions and forecasting will become even more important, and they'll be scrutinised and tested even more closely. We're getting close to running out of time, so I think it might be best if I finish up there and throw back to Isaac to see if we've got any questions left in the time that we've got available. Are you there, Isaac?
I am. Fantastic. Thank you for that, Kelly. That was very insightful. So as Kelly just mentioned, we're going to open it up to the floor for questions. So we have a couple of questions already, but if anyone has any questions, please feel free to send them through and we'll try and address them in the time we have left. So the first one is around the timing of financial forecasting. So how long should you be financially forecasting for, and when do you do that when starting a new project?
Okay, interesting questions. Thanks, Isaac. The length of time that you forecast for will depend on a number of factors. If you're a new business, you might only be able to forecast for 12 months to 2 years. Depending on the size of investment that you're looking for, some investors might want you to forecast out 5 to 10 years. It's really, really, really going to vary. You might be working on a short-term project within your business that you're going to go out and get some financing for and looking for investors. And you might just do your forecasting over the life of that project, which could be 6 months, 8 months, 18 months. So the length of time that you're actually forecasting for will depend on a number of variables. It also depends on the requirements of the person you're preparing that information for. Some people will want different periods of time. It's just all about their preference.
Okay. All right. The next question is, from your opinion, how does financial forecasting differ from budgeting? And then how does that integrate into business strategy and planning?
Wow. Okay.
It's a big question.
Yeah, it is a big question, and I'll try and answer that one quite quickly. Forecasting looks at the performance of your business, looks at the overall, all the activities of your business, whereas budgeting typically just looks at your cash in and out. What are you doing with it? And it's quite simple. Sorry, what was the second part of that question, Isaac?
How does that integrate into strategy? So business is like overarching business strategy, and where should it be used?
Yeah, okay. Typically, my experience is you'll sort of define a number of strategies to start with, and you may prepare financials and forecasts and budgets for all the different strategies until you find one that actually makes sense. You might have a strategy that seems great from a business rollout, operations, market share type perspective, but you can't make it work financially. It might not be the right time. It might be something that you need to do in a future period of time. So by overlaying your strategy, your budget and your financials, it's going to help you make decisions amongst sometimes seemingly unlimited choices. It'll help you focus on the 2 or 3 things that you potentially can do and deliver, as opposed to spreading yourself too thin and trying to do everything or making decisions about things that aren't going to provide you with the best return.
So using it as a tool for strategy, as like an integrated tool, basically.
Yes, yeah, definitely. So yeah, a business may do strategic planning and come up with many different options to move forward. And then if they budget and finance out the cost of those strategies, the return of those strategies, some may make more sense than others and help them make decisions based on many options.
Okay, and the next one is from an auditing perspective, when do you go to an outside body? When do you engage the help of financial advisors / advice?
Again, that's hard to give a simplistic answer to because the financial space is highly regulated and highly legislated, and it would depend on the life stage of where your business is at. You know, if you're planning to start a business, there's no requirement really to have anybody else look at your financials or your estimates or your forecasts. But if you're a large organisation that's been operating for a long time, you may have external shareholders and large numbers of venture capitalists where you would be audited continually, and that would be reported back to your shareholders. So again, the need to go out externally depends on where your life cycle stage of your business and where you're at, what it is that you're trying to achieve with those numbers, whether you actually need them verified by an auditor or some sort of external body to give them some validity. And it'll depend, if you've got shareholders or stakeholders and what sort of information they're looking for.
Okay, fantastic. All right, well, that's all the questions we currently have asked. So thank you again, Kelly, for your time today.
Thanks for the opportunity. Thanks for tuning in, everyone.
So just before we wrap up, I'd like to bring up our next webinar. So our next webinar is on how leadership and culture influence innovation success. And that'll build obviously upon what Kelly's been talking about, but also the previous webinars have also covered. So to register for this one, you can simply visit the Impact Innovation Lab page or on the Impact Innovation website. And finally, if you found value from today's content, please make sure to join the lab community on LinkedIn so that the conversation today continues into the future. And be sure to keep an eye out on emails as well for next time. So that's about it. So we'll see you all next time.
Thanks, bye.